Car payments just hit a record high. Car prices didn't. So why are millions of people paying more for a car that still carries the debt of the one before it? You're only looking at the monthly payment. You're missing the part of the loan that never got paid off. The debt doesn't follow the car. It follows the borrower. Walk into a dealership finance office today, and negotiations still often come down to one sheet of paper with 4 boxes: the price of the car, the value of your trade-in, your down payment, and your monthly payment. The FTC calls it the 4 square. On paper, it looks like transparency. In practice, it's a way to move the same amount of money between boxes without you noticing. Push back on the price, and your trade-in value quietly drops. Push back on the trade-in, and the loan term quietly stretches. By the time you leave the table, you can win almost every argument in the room and still finance the exact total the dealer wanted from the start. There's one box this negotiation naturally pushes you toward: the monthly payment. Not because everyone in the room has bad intentions. Every person at that table is rewarded for focusing on a different number, and there's one thing this negotiation can quietly bury: the gap between what your old car was worth and what you still owed on it. That gap has a name: negative equity. It doesn't vanish at the signing table. It gets folded into your new loan before a single dollar of new value is added. It starts collecting interest from day one. The average down payment on these deals is just over $2,000, barely enough to dent that gap. The debt doesn't follow the car, it follows you into the next contract. For a lot of dealerships, the car itself is just the front end. The real profit is often the back end, the financing. A longer loan does one thing well: it lowers the payment, but a 7-year loan doesn't make the car cheaper. It only moves the same price into smaller pieces, and it creates another problem: more interest for longer. Lenders often let dealerships mark up your rate and keep a share of the difference. Again, this isn't one villain in the room. It's a structure where every party optimizes for a different number. You for the payment, the dealer for the sale, the lender for the interest. And the buyer isn't choosing debt over affordability. The buyer is choosing the only number the system hands them to compare. In the second quarter of 2026, nearly 1 in 3 new car trade-ins carried debt like this into a new loan, an average of $6,884, a record for any second quarter on the books. This didn't come out of nowhere. Many of these buyers financed their previous car during the 2021 to 2022 chip shortage, when prices ran far above sticker. As used car values came back to earth, the gap between what people owed and what their cars were worth came right along with them into the next trade-in. $6,884 is the gap attached to one car carried by one household in one budget this month. Part of the reason the gap doesn't close on its own is the loan term. A generation ago, most new car loans ran 4 or 5 years. Now the average is almost 6. In the early years, most of what you pay goes to interest, not principal. That's just how amortization works. And for the buyers already carrying that gap into a new loan, the term stretches even further still. Over 40% of them now sign an 84-month loan, 7 years, chasing a lower monthly number that never actually closes the gap underneath it. Picture the timeline. Day 1, you drive off the lot, and the car is already worth less than what you paid. Month 18, you've made a year and a half of payments, mostly interest, and the loan balance has barely moved, while the car's value has moved a lot faster. By the time many buyers are back in a finance office trading in for the next car, those two lines still haven't met. 2 curves moving in opposite directions, one falling fast, one falling slow. The space between them is negative equity. Buyers carrying rolled over debt now pay $944 a month on average. That's $167 more than everyone else. The payment looks only slightly bigger. The lifetime cost is not. $16,270 in interest over the life of the loan versus $9,811 for the average buyer. One number creates options, the other creates limits. So who carries this risk? You do, not the dealership, not the lender. Sell the car and you cover the gap in cash on the spot. Trade it in and the gap doesn't disappear. It rolls into the next loan, starting even deeper underwater. It can happen fast. The car breaks down or just stops being enough. A trade-in gets negotiated, and within days, the old debt has already moved into a brand new contract, quietly attached to a car that hasn't been driven off the lot yet. On many mainstream models, the powertrain warranty runs out around year 5. An 84-month loan still has 2 years of payments left. After that, these repayment pressures aren't evenly spread nationwide. Auto debt tends to run highest in the places where households depend most on driving. States like Texas, Florida, Louisiana, and Alaska, where getting to work without a car often isn't realistic. Federal Reserve data shows auto debt 90 days or more past due just hit 5.6%, well above the long-term average of 3.59%. For subprime borrowers, it's worse. In February 2026, the share of subprime auto loans at least 60 days past due hit its highest level since Fitch Ratings began tracking the metric in the early 1990s. That's higher than the peak recorded during the 2008 financial crisis. Not a housing-sized crisis, a different market, a different mechanism, but the same underlying signal. When credit expands faster than the value of what it's attached to, the payment survives longer than the asset does. Once a pattern gets large enough, it stops looking like individual bad luck. It starts showing up in regulatory data. The CFPB now publishes quarterly auto lending data that tracks the deterioration showing up across the market. Official confirmation of the pattern, even without a policy fix yet. The buyers who need the loan most have the least room to absorb a bad trade-in later. The debt doesn't follow the car, it follows whoever can least afford to keep carrying it. Zoom out, and none of this stays personal for long. Dealers and lenders don't usually hold on to these loans. They sell them. A dealership can make money from a loan it will never hold. The risk can leave the building before the buyer even drives home. The moment your loan leaves the dealership, the person who approved your payment may never see your financial situation again. The most important question is no longer who owes the money, it's who owns the risk. After the contract is signed, the loan doesn't disappear, it gets transformed. It moves from the dealership to a finance company, into a pool with thousands of other loans, gets rated by an agency, and ends up owned by an investor who has never seen the car. Thousands of individual loans, including the underwater ones, get pooled together and packaged into bonds, auto asset-backed securities. The investor buying that bond doesn't know your name. They don't know your income. They don't know that your powertrain warranty runs out before your loan does. They only know one thing: a monthly payment is expected to arrive. Your monthly payment doesn't disappear when the contract changes hands. It just changes who is waiting for it. Those bonds get sliced into layers, from riskiest to safest. Some of the senior tranches can receive AAA ratings and get sold to conservative investors, pension funds, insurance companies, the kind of investors only allowed to hold very safe assets. The car disappears. The payment remains. Why would a pension fund want a piece of a stretched out car loan? Because most people keep paying their car loan longer than almost any other debt. Losing the car often means losing the job. Here's the strange part. The system doesn't need every borrower to win. It only needs enough of them to keep paying. That's what allows lenders to keep approving 84-month loans to buyers who are already underwater. The risk doesn't stay with the lender for long. It gets sliced up and sold on within 384. Is the gap in one person's budget. $1.69 trillion is the machine carrying millions of those gaps at once. Here's what that actually means. Americans spent about $620 billion buying new cars last year. $1.69 trillion is enough to buy every new car sold in the country for almost 3 years straight, before a single one of those buyers takes out a loan. Or, look at it another way. Split evenly across every person in America, not just car owners, everyone. It's enough to hand every single person in the country a $5,000 bill, and the country would still owe more. Not a number on a spreadsheet. Millions of individual payments, due on millions of individual days, in millions of individual households, every single month. The 84-month loan was never built to make cars affordable. It was built to make an unaffordable car look affordable, one monthly payment at a time. For much of the 20th century, buying a car meant absorbing depreciation directly. You bought it, it lost value, and that loss was yours to feel. Today, the question has changed. The car is no longer just something you buy. It's a payment stream that follows you. Trade-in after trade-in, contract after contract, long after the car itself is gone. So what is a car loan actually supposed to optimize for? Access to a working vehicle, or the ability to finance a higher price, one lower monthly number at a time? Is this system expanding access, putting transportation within reach of more people, or is it hiding rising costs behind smaller numbers? The question is no longer whether people can afford cars, it's whether a system built around monthly payments still measures affordability at all. The payment starts on day one. The ownership may never catch up.